Good evening, everyone. Good evening, dear students. How are you all? Are you all good? CA inter students, we are good. So today we'll be starting with this very interesting subject of financial management, right? And we'll just get started with the subject, get ourselves introduced with this subject because we'll be learning this subject for the first time, right? So I think you might have learned till now. Basically, if you are only a 12th standard student, you might have learned, accounts or maybe some commerce subjects, some economics, some mathematics, right? So now we are going one step ahead in our study where we are actually discussing about, um, you know, how do we go about understanding finance or just from recording the entries in our books of accounts as we did in the accountancy subjects. We just take it ahead to the next level where we are going to analyze the financial statements now, right? So in the discussion journey of this financial management or analysis of financial statement management, we are going to cover a lot of things, starting from a very basic thing to a very high advanced level. Certain aspects we're going to cover at inter level, and then we also have advanced financial management at CA final level also. Okay. So now let's just first understand uh, a very unique subject that we are going to learn, which we are going to call out over here as financial management. Okay. So let's try to understand this word financial management. I mean, let's just discuss what this subject is going to be all about. And then we can think of what scope, what objectives are there in this particular subject. Now, first up, let's try to understand this in a very simple way. When we say financial management, the word financial management, if you just try to understand what is that word really. So let's say we talk of the word financial management. Okay, we're talking of the word financial management. So if I just break it into two parts, one component of the word is financial. Right? So one component of the word is financial. Other component is basically management. Right? So one of the component is financial and other is typically the management. Now, when we're really discussing about this word of financial management, from the first word financial, what do you really understand? Yep. What do you understand by the word financial? And then we'll go to the next word, definitely the word of management. But if I just want to understand, what is your understanding about financial? Yeah. Or just maybe finance. Funds, money or finance. Okay. Money, funds. Okay. To simply understand, financial means we're talking of funds or money. Absolutely correct. And when I say financial management, that simply means, can I say management of funds or money? So it's going to be simply management of funds or money, right? So we know funds, we know money, we know what finance is, what all funds are employed in a business. But then let me just focus on this particular word of management, right? What do you mean by the word management? Let me just have an idea from you. What do you understand by the word management is? Management, not with specific to, financial management, but in general sense, if I ask you what do you mean by management? Handling, controlling, tracking, संभाल कर use करना, okay? To manage something, operating, okay? Planning to achieve a significant goal, leading, planning, leading. Okay, so functions, you're talking of functions of management. Now, in essence, when we talk of management, it has got primarily two tasks. One is raising of funds, or I can say just the word management. The first part is raising of resources, and the second part is allocation or utilization of resources. Right. So this is raising of resources or allocation or utilization of resources. You talk of any manager, right? Apart from, we're not talking of finance manager as of now, you talk of any other manager. For example, the production manager. What do you think? What will be the activity of a production manager? What sort of activity would a production manager undertake? Yeah, production manager. If I'm talking of a functions of a production manager, what sort of function or what sort of activity would a production manager do? Can I say production manager would be obviously interested in raising of the production resources, basically your material, right? You're getting the material, getting the technology, you're utilizing into your business and using it to the best possible extent, right? If I talk of HR manager, the human resource manager, what would a human resource manager do? What functions would a human resource manager be undertaking? Human resource manager. Can I say it also does the same thing? Raising of human resources for the organization and putting them into appropriate roles, right? So raising of human resources, basically raising of employees, and then putting them into appropriate roles or putting them or giving them appropriate roles or assignment in the particular organization. Right. So these two are the activities that an HR manager undertakes. Now coming to our dear finance manager. What activity would a finance manager do, right? So if I talk of a finance manager, it will be also undertaking two activities. One is raising of funds, and second is allocation of funds, right? So we're like looking at two activities, getting funds and investing funds. So finance manager, we can say raising of funds and allocation of funds. First is like getting the funds for the organization and then investing it or allocating the funds into the organization or allocating funds into different areas of the organization. Am I right? This is what a typical finance manager would do. That's what the role of finance manager is, guys. The finance manager is supposed to be getting the funds for the business and investing it in appropriate areas, right? Raising and allocation of funds, generally we call it as investment of funds. Now, coming to the part of raising of funds. What all decisions would you as a finance manager undertake? Just think of a finance manager whose activity is to get the funds for the business. What sort of activities would you be really undertaking to get the funds? First of all, can I say you should be knowing what are the different sources of funds that an organization has? Am I right, guys? Where to raise the funds, right? We need to look at what all sources of funds do we have. Can you name few sources of funds, guys? Can you name a few sources of funds? Yeah, please go ahead. Loan, shares, debentures, banks, debentures, rental income. Nah, what's rental income? That's not a source of fund. We are starting a business. We are going to invest money into the business. So from where do I need to get the money? Venture capital fund, owners contribution. Okay. Capital market. Okay. Bond, loan, shares, owners capital, IPO. Okay. Okay. VC funds. Okay. So as a finance manager, you should ideally be knowing what are the sources available for funds. So raising of funds, we can say sources of funds. right? Raising of funds, we can have one aspect as the understanding what are the different sources of funds. Don't worry. In today's session itself, we are going to learn a lot of sources of funds. We're going to discuss a variety of sources of funds. For that, I have prepared for you a very beautiful diagram, which I'll be definitely sharing with you on the portal, on the viewers portal. So you can see this particular diagram. I prepared it for you guys, uh, using which you will be, will be able to cover up the entire chapter of sources of funds. Okay, don't worry, we'll be discussing that. So, yeah, coming to the role of finance manager. So, as a finance manager, you should be initially knowing what are the different sources of funds that you have got. What are the various sources of funds that you have got? Second thing, after understanding the sources of funds that we need to look at is, once we have decided what are the sources of funds, then I need to decide from where should I raise the funds, right? So if I'm telling you, let's say the company has got 15 different ways of raising money for its business. Let's say company has got 15 different ways of raising money for its business. Um, can you tell me how do I decide that out of those 15 sources, which options should I choose? Suppose the company can uh, get money by way of equity shares, by way of preference shares, by way of debentures, by way of bank loans, by way of commercial papers, by way of leasing or some other sort of, there are multiple such options. How do you decide which sources of funds are you going to choose? How do you decide which source of funds should be used to get the money? Can I say we should understand uh, that whenever you're going to raise the money, it's not a free lunch. You get a free lunch, guys. You get the money at a freely. Someone gives you money as it is. That okay, you keep the money whenever you want. You can return it back, or you can just keep it away. We are okay with that. One gives you money free of cost, right? So for raising money, also you need to incur cost for the money, right? So ideally, we should be understanding that apart from just raising funds for our business, we should be also understanding, sir, which sources are available for us, and out of those sources, how do I decide which is the option that I should choose? I mean, the decision of the option to be chosen depends on the cost of the funds, and therefore, the second role which the finance manager needs to know is understanding what is cost of capital, right? On the basis of understanding the cost of capital, right? You have 15 different sources of funds, and each type of fund has got its own cost. Each type of fund has got its own cost of capital. So we need to know what is the cost of capital is. We need to understand what is the cost of capital of different sources. Like what's the cost of equity shares, cost of preference shares, cost of debentures, cost of bank loan, cost of commercial paper, cost of overdraft, cost of cash credit, and a whole lot of other sources. So all the sources of funds, we need to know what is the cost. Now, once you have decided that, okay, these are the sources of funds which are having the lowest cost, what should be the next step? What should be the next step? Yeah, yes, tell me. So out of those 15 sources of funds, let's say you have shortlisted 3 sources of funds which are of less cost to you. Okay, you have shortlisted 3 sources of funds which are of less cost to you. Now, what should be your next sort of action? And it is with regards to raising of funds only. With regards to raising of funds only, you tell me what should be your next course of action. Now, what should be your next course of action when you are looking at, I have identified those 3 sources. What should be your next source of action? Comparison, issuing prospectus, no. Procurement, capital structure, yes. The next course of your action will be to understand how much of debt and how much of equity, how much of preference share to be issued, right? Understanding how much of these sources are to be, how much of these sources of funds are to be used for raising money, correct? So we should understand that if we have shortlisted, let's say equity share capital, preference shares and debentures, understanding what should be the proportion of raising this money, right? Understanding what is the proportion of raising this money. So that's basically understanding something called as capital structure. Okay, that's called as a capital structure. So sources of funds, first step, understanding what are the sources of funds. Second is calculating the cost of capital for each type of funds. Third is working out the capital structure. So working out capital structure means what should be the quantity of equity share capital to be issued, what amount of debentures to be issued, what amount of preferences to be issued, how much overdraft is to be undertaken. All those aspects are going to be taken care in the topic or in the discussion about capital structure. What should be the structure of your capital, right? If you are investing, let's say, 1,000 crores into a business. Now, when you're investing 1,000 crores into a business, it doesn't mean that entire 1,000 crore has to be by way of your equity shares, right? It doesn't mean that. It can be by way of some amount by way of equity, some amount of debentures, some amount by way of preferences. Now, what should be that amount? That discussion is going to be undertaken in the topic of capital structure. Okay. Then, not just understanding this, once you have understood how the capital structure is going to be raised, now another aspect of capital structure will come into place. Understanding what is capital structure effect on value of business. So what is the effect of capital structure on the value of business? So we have sources of funds, cost of capital, capital structure, and then effect of capital structure on the value of business. That's the raising of funds actually, right? Second aspect, allocation of funds. Coming to the next aspect now, allocation of funds. Once you have decided which are the sources available, you have computed what are the cost of raising those money, you have computed what proportion of debt, equity, preferences are to be issued. You have understood how much debt is going to give what value to your business, how much equity is going to give what value to your business. Now you go to the other aspect, which is allocation of business. I mean, allocation of funds. In business, how can you utilize the money? Where can you put the money? Suppose you raised 1,000 crores by way of raising equity shares. Okay, suppose you raised 1,000 crores by way of equity shares. So can you tell me, if you have raised 1,000 crores by way of equity shares, if you have raised 1,000 crores by way of equity shares, can you tell me, where am I going to put that money? How can I invest that money? I'll obviously buy certain assets, right? I'll always obviously buy certain assets. But if I ask you, give me the classifications or the types of assets in which you can put your money. Give me the classification or types of assets in which you can put the money. One is okay, fixed assets, definitely. Yeah, other is in the current assets, definitely. Okay. Fixed assets, working capital, perfect. So allocation of funds wise, you're going to first discuss which machinery should be purchased, where should we be placing our factory, where should be where should we build the factory, which land we should purchase, what all equipments or furnitures we should have. So that's about investing into long-term assets or non-current assets or fixed assets. So investment in fixed assets, right? Investment in fixed assets. So allocation of funds, we can have the first idea, which is investment in the fixed assets, right? So investment in fixed assets, it will be like understanding whether we should buy a particular asset or not, whether we should invest in a particular asset or not, right? So one thing you can do is investing into the fixed assets. And this is basically you're making a investment decisions. Okay. Then next, where other can you put the money? You can definitely put the money into the working capital, right? So you can invest it into working capital. Now, if you have some sort of excess money with you, you can obviously think of paying out dividend. Now, dividend payment will be is mandatory for the preference shareholders and it's optional for equity shareholders, right? So you get the money, you're going to invest into different areas. And this is what the function or what's the role of a finance manager is. Apart from this, as a finance manager, you're also supposed to undertake financial analysis of the statements or analysis of the financial statements. You're also supposed to undertake analysis of financial statements. You're supposed to undertake the analysis of financial statements, right? Now, analysis of financial statements, there are two topics that we are going to do. One is the ratio analysis, and the other is leverages. Okay. Working capital is basically investment into the current assets that you're making. Like how much stock you should keep, how much amount of credit period should be given to the debtors, how much credit period should be availed from the creditors. All those are your working capital management decision. Right? Capital structure can also come under allocation of funds. No, capital structure cannot come under the allocation of funds because capital structure is deciding how much debt, how much equity, how much preference share is to be done. I mean, how much of that amount should be raised. And in analysis of financial statement, we are going to do two topics. One is ratio analysis, and second is leverages. Leverages is basically understanding how risky the business is from the perspective of its operations and from the perspective of how it has been financed. Okay, so leverages is basically understanding the risk or measurement of risk. Okay, so if you look at this, this is what your syllabus for CA Inter looks like. So we are actually going to understand what is the role that a finance manager is going to perform. So it could be raising of funds by way of different sources. Second is by way of cost of capital. Third is through understanding or deciding how much capital structure should be implemented. Then capital structure effect on the value of the business. Allocation of funds would be investment in the fixed asset, maybe by way of investment decisions. And then understanding how much working capital to be maintained. And also taking a decision with regards to dividend payment. Now, analysis of financial statements, we can say it's ratio analysis and leverages. Okay, so leverages is understanding or analyzing the risk that is involved in a business. Ratio analysis is simple calculation of certain ratios to draw a conclusion whether a company is really doing good or not, and in what areas it's doing good, and in what areas it's not doing that great. Okay, so that's the typical role that a finance manager is supposed to do, and that's what our CA Inter syllabus is. So are we good till now, everyone? Are we good till now? Yes. Yes or yes, guys? Yeah. Okay. So right now, first let's understand what's the scope for a finance manager is. Okay. So scope for a finance manager. As I have discussed, finance managers, the scope, it has to be, one is getting the money and second is investing the money. So as I said, the sources of finance we are going to learn. We're going to see what is the cost of capital. We're going to see what's the leverage, what's the capital structure, and also understanding where we should invest the money in the form of working capital, in the form of fixed assets, and in the form of dividend, and also undertaking ratio analysis by way of typical financial analysis. Now, what are the tasks performed by the manager? What are the tasks that are performed by the manager? As I said, raising of funds and utilization of funds. Raising can be by way of primarily owned funds or borrowed funds. You can't raise money by any other means other than owned funds and borrowed funds. And utilization of funds would be into non-current assets, current assets, and through the investments. Okay, that's the typical scope or meaning of financial management that we have already discussed. Now, when we talk of the next aspect, which is what is the scope of the financial management? Right, so scope of financial management. What all areas are covered in this subject? First, we need to determine the size and the rate of growth of enterprise. That is understanding at what rate our company is growing. What should be the composition of assets, like how much inventory, how much debtors, how much cash we need to maintain. Third is what should be the debt equity mix, which is the capital structure, and planning, controlling of the financial affairs of the company. Okay. Now, there is a common term that we find in day-to-day lives also, and also due to recent Shark Tank and all such shows, people are becoming more of aware about this term. Something called as value of a business. You watch Shark Tank, guys? You watch Shark Tank? Yeah. You used to watch? Why have you left it? Just because that guy has left? What was his name in Shark Tank? Ashni Rover, yeah. So just because that guy has left, you have stopped watching it now. So your star is not there in the show. You decided to quit watching it. Yes, Rajveer. No. Anyways, coming back. So in that Shark Tank, there's a common term that they use, which is called as valuation kitna hai. Right? Am I right? Valuation kitna hai. This is they're generally talking on that, and they generally say that we want let's say 10 lakh rupees. We want 10 lakh rupees for let's say 5% equity. We want 10 lakh money. We want 10 lakh amount for 5% equity. So based on this, what's the valuation that we can derive? If 10 lakh is for 5% ownership of the company, can I say value of the company stands as what? 2 crores? Right? Because the valuation is simply 10 lakh divided by 5%. They're going to give 10% for 5% of the company stake. So what should be the total value of the company? That works out to be 2 crores, right? Right. So this is the valuation that they are negotiating, they are bargaining upon. But there has to be an objective way, a systematic way of understanding uh, how to determine the value of typical business, right? Now, when we talk of how do we go about determining the value of a business, we talk about, going for understanding the value of a business. We should know that value of a business depends on certain aspects. The value of a business, I say, it's a function of financing, investing. That's the value of business is going to be a function of financing, investing, and dividend. Right. So the way company is financed, the way company is investing its resources, and the way company is paying dividend to its investors, that's going to determine, how much is going to be. That's going to determine how much is going to be the value of a business. Okay, so that is something that we really need to understand. The value of business is going to be dependent on your financing activity, your investing activity, and the dividend decisions. Okay. Now coming to financing. Can you tell me value of a business will rise if the cost of financing is going to decrease or increase? I mean, value will be high when the cost of financing is low or high. What would be your answer? Yeah. So if you want your value of business to increase, if you want the value of a business to be growing, your cost of financing should be high or it should be low? It should be low, definitely. Right? So cost of financing should be lower. So because lower cost of financing is going to be adding, that will add more profits for business, which will ultimately lead to increase in the value of the business. Okay. Now, again, we say that the value of business is going to be more if the rate of return on investment is high or low. Tell me, which one of these two? When would you say that the value of the business is growing, value of the business is higher? When the return on investment, rate of return on investment is high, definitely. So high rate pay, if you're going to put your money by getting the money at a lower cost, that will lead to increase in the value of a business. That's a very simple and fundamental understanding, right? So it's like if you talk of a business, It's nothing but acting like an agent or acting like a transporter of money. So business gets funds, right? In the business, we raise the fund and we are going to invest the funds. So when we are going to raise the funds, let's say there will be some cost. Now, if this is, you're getting funds at, let's say, 8% cost, what should be the rate of investment? What should be the rate of return on investment, which will lead to high valuation for the business? If you're, let's say, if your cost of funds is, let's say, 8% per annum, can I say the investment has to be greater than 8%? It has to be greater than 8% because then only your valuation will start making, when only you're making profit out of it, you're making money out of it, right? Correct. What would happen if the business is getting funds at 8%, but investing it at 6%? What would happen if the business is getting funds at 8% and investing at a rate lower than 8%? Can I say business may not show losses? Business may not show losses because ultimately losses are shown by way of accounting area. But can I say value will decrease? Right, guys? Can I say the value will decrease? So as the funds are increasing, as the funds are raised, investment rate has to be higher than the rate at which you are going to raise the funds. So cost of capital is 8%, whereas investment rate is more than 8%. Then only it makes sense for the value to increase. Then only it makes sense for the value to increase. Otherwise, the valuation is going to decrease. Right? So simple fundamental. The rate at which you are raising the money, that has to be lower than the rate at which you are putting the money. So if you are raising money at a lower rate and you're putting money at a higher rate, that will lead to increase in the valuation of your business. Right? So when you're looking this term as a value, it's a very interesting term and there's a lot of debate ongoing in the market. How do you determine the value? And till now, you don't have a very black and white method or a very straightforward method to determine the value of business. Right? So to determine the value of business, we've got a lot of different methods. We follow all of them depending on the scenario because all of them give us a base for at least starting with the negotiation. Right? At least to start the negotiation, that's the valuation is being asked for. Okay. Now the point is, a debate is ongoing. What will be the objective of the finance manager? So the finance manager who is involved in raising of money, investing of money, raising money from different sources, investing into working capital or fixed asset. Now the point is, where should we really, what should be the objective of, what should be the objective of the finance manager? Optimum utilization of finance, okay. Now if I give a choice, the role of finance manager is profit maximization, and second is role of finance manager is wealth maximization. Right? So profit maximization and wealth maximization. Profit maximization and wealth maximization. What should be the objective? As a finance manager, should you be looking at profit maximization or wealth maximization? Of course, it has to be wealth maximization and not profit maximization. It used to be a long way back, maybe half a century old concept that the motive of business is to maximize profit. But right now, in this age of startups, do you see really these startups making money by way of profits? Are they making profits? No, sir. They're making losses. They are having sustained losses. Maybe no profit situation also, or very minimal profit also. But still, their objective is to maximize the value of their business. The objective is to maximize the valuation or value of the business. So, understanding that profit maximization is a very traditional concept, right? It's a very traditional concept. Whereas wealth maximization is a newer concept. How is it different? How is it different? Can you just think of some points of distinction between the wealth maximization and profit maximization? What could be the lines of difference between profit maximization and wealth maximization? The reasons for difference or lines for on which the difference will arise. If loss, then how business will survive? Business will survive even in loss by way of funding. When you can raise funds from the investors, the business is still going to survive. Wealth will remain permanently. Exactly. That's a very valid and a very good point made by Aman. So wealth will remain permanently, whereas profit will be something, that will be just for one of the years. You may have profit for just one of the years. Next year, you may not have that high profit. But if you have created wealth, that's going to be there with you for a long term. Okay. Wealth is increasing the economic resources. What is wealth and how it is different from the profit? Wealth is basically, you can say, maximization of shareholders' wealth. But you want to maximize the market price of the shares. Okay. So if we just look at what are the points, what are the differences between them, let's try to understand this simply with these few pointers. Profit, we know it is calculated as what? Profit is simply income minus expenses. Right? So profit is simply income minus expenses. So we can say profit will get maximized with the increase in income and reduction in expenses. So profit will become maximized when the income increases and expenses reduces, right? Whereas wealth, we say wealth is nothing but present value of future benefits minus present value of future costs. So which is something which is a visionary term, it's wealth, because you're looking into what is going to happen in future. Because when you say wealth maximization, your objective is to look into what's going to happen in the future or profit, right? So future is something where you're looking at when you're looking for wealth maximization. Whereas immediate in near term, we can say we are looking for profit maximization. Okay, the term profit is going to be a vague term. Vague term means the amount of profit that you compute will differ according to the assumptions, will differ according to the estimates that you make. When you're preparing the books of accounts, when you're calculating the profit, aren't we estimating a lot of things? Aren't we estimating a lot of things? Yes or no? When we're preparing the books of accounts, aren't we estimating? Like the value of the stock is estimated, the amount of depreciation is estimated. So all these estimations, are they 100% accurate? They're subject to errors, right? And therefore, the term profit is vague. But whereas when you look at the term wealth maximization, it is simple, present value of future benefits. So what is the amount of future benefit that you're going to get, right? When you look at what is the amount of wealth you can get in future, right? And then take the PV of it, and then PV of future costs, which is present value of the future expenses. So going ahead, forward looking, visionary term is your wealth because you're looking into the future. But in case of profit, it's just for that one particular year. The term profit is definitely a vague term, right? Because when we look at the term profit, it is something, income minus expenses. And these income minus expenses are subject to fluctuation, are subject to value differences because of the estimations when we prepare the balance sheet and P&L. Wealth maximization is, a cash flow approach. I mean, what do you mean by the cash flow approach? Let me just make you understand that cash flow is more important than that of, balance sheet or than that of the normal profits. How is it? Let's have a look at it. Okay, so let's say you start a business with some equity share capital of, let's say, 50 lakhs. Okay, so when you're starting your business with the equity share capital of 50 lakh, of course, there will be a counter position in the cash also. So you'll have in your cash, you'll have a balance of 50 lakhs. So equity share capital 50 lakh, cash is also 50 lakhs. Now you say that there has been a sales. Okay, but sales you should have purchased, yes. So we purchased goods, let's say worth 10 crores, right? So of course, if you purchase goods 10 crores on credit, where will be the second effect? Where can you see the second effect? If you're saying that you purchase goods worth 10 crores on credit, what will be this? Where in the financial statement are you going to look at the second effect? Creditors, right? So you've got creditors in your books worth 10 crores. And now you're saying that we have sold this particular goods at a profit. So we're saying we made a sales of 12 crores. And of course, on credit. So we're saying that we sold these goods on credit. If you're selling the goods on credit, can I say you're going to have debtors in your balance sheet? And that debtors is going to be 12 crores. So are we booking some profit over here? In our P&L, will we be able to book some amount of profit? Yes. What's the profit? We say profit is 2 crores. Now this 2 crores comes with equity in the form of reserves. And then your balance sheet gets tallied at 12 crores 50 lakhs. The balance sheet gets tallied at 12 crores 50 lakhs, right? The balance sheet is like at 12 crores 50 lakhs. Now tell me, over here, with the 12 crore 50 lakhs value, is there any cash flow that has happened in the company? Any cash flow has happened in the company? If you show this balance sheet to a banker and say, see, banker, we have made a profit of 2 crores. Can you please lend us money of 1 crore for our future expansion? Will the banker accept our offer, or will the banker reject our offer? The banker will definitely will say, go to hell. What the hell have you bought this as a balance sheet and P&L? Do you think we are fool over here? We don't understand this business. You have just made the book entries. There is no cash flow. In your bank account, there is no cash inflow. There is no cash outflow. So you've actually not done a good business. You've just made a good books of accounts with good amount of profit. And that profit is only in the books. So do you think by doing this sort of business, a company will be able to generate value and the company will be able to maximize its shareholders' wealth? Do you think the company will be able to maximize the shareholders' wealth by doing this? No, it's just a book entry. Who knows whether the sales are genuine, whether the purchases are genuine? If you want to understand if the sales and purchases are genuine, then I say you should be having the cash flow for that. Am I right, guys? We should be having the cash flows for that. Correct? So we should be having cash flows, and therefore we say that when we are looking at wealth maximization, we are not looking at just the book profits. We are looking at the cash flows. So when we say we're looking at the cash flows, we are essentially talking of what will be the value of cash inflows and outflows that we are going to have. Okay. Right. So therefore, we say that wealth maximization is a more better term. Now, profit maximization actually doesn't take into account the risk factor that we have. So like if you're looking for profit maximization, maybe you will start selling goods at a higher price, or maybe start selling goods at a lower price. But when you're going to sell goods at a lower price, can I say the cost of production is going to be lower? So, and if you want your cost of production to be lower, will the quality of the product suffer or not? Is the quality of the product going to suffer or not? If you are continuously focusing on reducing the cost, is your quality bound to suffer or not? Of course, yes, sir, the quality is definitely bound to suffer. And reduction in the or compromise of the quality of your products or services, isn't it a risky proposition? Isn't it a risky proposition? Definitely, yes. And if that's a risky proposition, can I say you are trying to maximize the profit? Maybe one of the years you'll be able to maximize the profit because of lower cost. But next year, when the complaints start coming in, the repeat sales will take a hit. And that's why you're taking the risk. So profit maximization is just not looking at the risk parameter. It's like you ignore the risk and just focus on maximizing the profit. Sell the goods at a higher price, buy the goods at a lower price. The difference is your profit. Just try to maximize that. That is something, which is really problematic. So it's a risky situation. So you're not looking at essentially what the risk is, right? Moreover, we say profit is, it's a very narrow term. It's a very short-lived term. It's a very small term. It's not looking at a magnanimous view of the business, right? Now, how do we go about considering the risk when we are looking at the wealth or value maximization? See, I'll just tell you. As I said, value is going to be present value of cash inflow minus present value of cash outflow. So value is going to be present value of cash inflow minus present value of cash outflow. Value of the business is going to be present value of cash inflow minus present value of the cash outflow, right? How do we calculate present value? Do we know A is equal to P into 1 plus I raised to N? I hope you all are aware about this formula. Are you aware about this formula? Amount is equal to principal into 1 plus I raised to N. Yes or no, guys? Yes. So simple. In your foundation years, in the foundation exams, you might have learned this. Amount is equal to P into 1 plus I raised to N. So, so amount is equal to P into 1 plus I raised to N, which is a compounding factor, right? It's a compound interest formula. Now, if I ask you, what should be P equal to? It should be A upon 1 plus I raised to N. So essentially, present value is going to be whatever you have to be coming in the future divided by 1 plus I raised to number of years. So present value is equal to future value upon 1 plus I raised to N. Present value equal to future value upon 1 plus I raised to N. Now, this I over here, I is the required rate of return. So A is equal to, we know, present P into 1 plus I raised to N. This is a compound interest formula, which we have already learned in our foundation. Right? There's a whole chapter of time value of money, which is there for this particular formula. Right? So it's based on the very simple formula. Chapter 4, right? Yeah. So we say present value is future value upon 1 plus I raised to N. Now, if I ask you, suppose you are investing 1 lakh. Okay. Your required rate of return is, let's say, 10%. Right? So what will be the amount or future value in year 3? 1 lakh invested at 10% for 3 years. What will be the amount or future value of the amount in 3rd year? What will be the amount or future value of the amount in 3rd year? Can we simply calculate it as principal into 1 plus I raised to N? So this is principal and this is I. So principal into 1 plus I raised to N. So this is principal, which is 1 lakh into 1 plus I. So that's like 1.1 raised to 3. So that's 1,33,100. So amount of future value in year 3 will be 1,33,100. Correct, guys? So amount in future value is 1,33,100. So can I say, if 1 lakh is my investment in year 0, 1 lakh is the amount of investment in year 0. What is the amount? What's the value of my investment in year 3? It's 1,33,100. If 1 lakh is the amount of investment in year 0, that's going to be 1,33,100 in year 3. Correct? So I'm going to invest 1 lakh today to get 1,33,100 on a future date. Are we clear with this? Yes or no, guys? investment for a future value. So we need an investment of 1 lakh for a future value of 1,33,100. Or to put it other way around, for a maturity of 1,33,100, we need to invest 1 lakh now. Can I say it this way? It's like if I'm investing 1 lakh today, it will become 1,33,100 after a year. After 3 years. So the other way looking at it is, if I want 1,33,100 after 3 years, if I want an amount of 1,33,100 after 3 years, what should be the amount that I should invest today? What should be the amount that I should invest today? So can I say 1 lakh? Right? That should be the amount that we should invest today, which is 1 lakh. Right? So can I say 1,33,100 is future value of 1 lakh? Or I can say 1 lakh is present value of 1,33,100. So 1,33,100 is the future value of 1 lakh, or you can say 1 lakh is the present value of 1,33,000. So it's like when you do 1 lakh to 1,33,000, this is called as compounding. And when you do 1,33,000 to 1 lakh, this is called as discounting. So from 1 lakh to 1,33,100, that's called as compounding. And when you want to bring that future value to present value, that's called as discounting. And when we calculate the value, we simply take the present value. So it means we are going to take the discount. So I can say 1 lakh is 1,33,100 divided by 1.1 raised to 3. The present value of 1 lakh, the present value of 1,33,100 is 1 lakh, correct? That is at a rate of 10%. Now, if I ask you, what is present value of 1,33,100 if the required rate of return is 12%? If the required rate of return is, let's say, 12% instead of 10%, what will be the present value? Tell me, guys, what will be the present value? 1,33,100. When you're talking of taking the discount, it will be 1.12 raised to 3. How much is this number, guys? So if let's say my rate of return or my rate of discounting is, let's say, 12%, what is the value of the 1,33,000 that we are going to have in future years? Can I say it's 94,738? Right? Correct? So if I ask you that if I increases, present value dash, fill in the blanks. If I increases, what is happening to the present value? Is it increasing or is it decreasing? Decreases, right? The present value decreases, right? So that's where we say in our formula of future value upon 1 plus I raised to n, in our formula for future value upon 1 plus I raised to n, that I is simply your required rate of return. If you increase your required rate of return, what will happen to the PV? Can I say PV will fall down? Right? The PV is going to fall down. Now, if you look at any company or any business which have got a high risk, would you expect a normal return from that company or would you expect a high return from that company? If the company is into risky business, would you expect a high return from the company or a normal return or a low return from the company? High risk business. Of course, we will require a high rate of return. So if you require a high rate of return, the I the rate of return for that company is going to be higher. And can I say, since the company has got a high risk and also a high required rate of return, what will happen to the present value? What will happen to the value of the firm? What will happen to the value of the firm? Can the value of the firm will fall down? Value of the firm will be less, right? So the simple idea is, if risk increases, your required return also increases. Achha, required return increases means I increases. And as I increases, what is going to happen with the present value? As I increases, what is going to happen to the present value? Is the present value going to decrease or increase? Decreases. Right? The present value also decreases. So risk increases, the required return also increases, I increases, and then the present value also decreases. Okay. So when we are looking at valuation, wealth maximization, essentially we are incorporating that risk in our calculation, because if it's high risk, the rate of return will be higher. If the rate of return is higher, the present value will be lower. Right? So we are definitely involving the risk in the wealth maximization objective, but we are not looking at the profit maximization objective. Okay, so that's where the wealth maximization has a upper yield as compared to the other aspect. Now, generally, if you want to calculate the value of the business, it's going to be value of equity shares into market price per share, or this is going to be the value of the equity shares. If you want to value the business as a whole, it's going to be value of equity and value of debt clubbed or cumulative together. Value of equity plus value of debt. Okay. So if you look at some other differences, the differences could be, objective would be large amount of profit, whereas you'll always be looking for maximizing the market value of the shares. So profit maximization is a short-term objective. It doesn't consider the risk. Time value of money is also not considered. It requires immediate resources and it is easy to achieve. Just decline your cost of production, you'll be able to achieve the maximization of profit objective. But that's not going to be the case when we look at the other aspect. So highest market value of the shares, it's going to be a long-term objective. Risk is also taken into consideration. Time value of money is also taken into consideration. Direct and immediate relation between the decision and value. So there's an immediate relation, but it's not easy to achieve. Wealth maximization is a very difficult task because it takes into account both increase and decrease in the present value due to the risk aspect of it. Like, for example, if I ask you, Byju's, are you all aware about Byju's? Yes. So what has happened recently to Byju's? What about the valuation? What's the status? Any news that you have heard about Byju's right now? What have you heard about Byju's? It is filed for bankruptcy. Diwala nikal gaya. Okay, closed down. The great fall. Expenditure increased. Okay. Valuation decreased. You know what has been the decrease in the valuation of the business? Any idea about what percentage decrease in the valuation of the business? The business has been devalued by 99%. So it's like if the business was valued at 100, maybe 2 years back, right now it's just valued at 1 rupee. So 99% reduction in the value. Now, has the wealth declined because of lower profits? Not be sir, but the value has definitely declined because of not so bright future. Not so bright future about the business. Because that business model was itself flawed. Right? Remember, being into the finance industry from so many years and also interacting with my clients and interacting with the students, interacting with the alumni, the only idea is, to maximize your business wealth is to focus on your business and not focus on how to get the money for business. Right? Ideally, as I said, the role of a finance manager would be both raising of funds and utilizing of resources. But from practical perspective, if I tell you, from a very practical perspective, the focus of the owners, these two are definitely the activity of a finance manager. The owner should actually not be really interested in, how to get the funds. The owners should be so much confident that the money will be raised by any means, because we have a very good business model. If your business model is good, if your business is doing good, definitely you can get money from anyone. Any bank will be able to lend you, any NBFC will be able to give you money. But that's not the case if your business is not good. So if you want to focus on your business, you should be looking on wealth maximization and not profit maximization. Wealth maximization, sustainable profits, long-term growth, strong product profile, very attractive service centers, or maybe the model is, it's such that, customers are having a great degree of satisfaction, right? So now, if you ask me how to know the business model is really good, well, that is something which can be learned only through ages. As you age, as you lose some of your hairs, as you lose some of your sleep, as your hair starts growing, graying, or as your age becomes a larger number, you understand whether a business model is good or not. Don't ever dare to think of, that just by passing CA inter we'll be able to understand whether a business model is good or not. Seasoned players have failed in businesses. Okay, be it the brother of Mukesh Ambani, who's like Anil Ambani, or be it Kingfisher Airlines. Seasoned players, they are like one of the moguls of business world. They have failed to understand what a good business model is. So to understand a good business model, you need a very great degree of discipline, confidence, sensible decision-making power. So all those things needs to be developed. Right? So understanding a good business model, it's a very difficult task, guys. It comes with a age, it comes with time period, right? It comes with experience. Okay, what's TVM? TVM is time value of money, Sneha. Okay, now, what are the activities that a CFO used to do and what he does right now? So right now we have some of the very simple concepts, and then we'll just do it, and then possibly then take a break, and then we'll come back to go for understanding the sources of finance. Right? Now, what are the activities that a CFO used to do? The CFO used to do budgeting, how much money need to be spent in which area in the upcoming years. Forecasting, they used to undertake accounting activity, treasury management, internal financial reporting, filings for investors, tax filings, managing the debtors and creditors. What does a CFO does now? A CFO basically is undertaking the budgeting activity. He's also undertaking something called as the forecasting. He is also supposed to be undertaking the profitability analysis, pricing analysis, looking at the IT and HR activities, regulatory compliances, outsourcing decisions, whether we should outsource some of the activity or not, managing the risk of the business. All of that is, undertaken by CFO. The role of CFO has changed over a period of time. Okay. I'll be providing this PDFs, guys. Don't worry. I'll be uploading it on the portal. Okay. Now, there is this something called as a agency problem and agency cost. And this generally comes in case of joint stock companies. But on the other hand, if you just not look at the joint stock company, if I just ask you, like a sole proprietorship. In a sole proprietorship, are the owner of the business and manager of the business same person, or are they different? In a sole proprietorship, is the manager of the business and the owner of the business same, or are they different? They are same, sir. If I'm having my own restaurant, I'm managing the restaurant and I'm also owning the restaurant, right? But does that really happen in case of more sophisticated business structures like the joint stock companies? No. In joint stock companies, owners are a different class of people and managers are a different class of people. Who are owners of a joint stock company? Who are the owners of a joint stock company? Shareholders, exactly. The persons who are buying the shares of the company are the owners. Who are the managers? The managing directors, the board of directors, a general manager, maybe the CFO, or maybe the sales manager, maybe the CEO. Those are your managers, or the set of persons who are going to manage the business. So on one side, we have the owners or the risk takers, and on the other side, we have the managers. Now, these two persons in most of the cases are different. These two persons in most of the cases are different. And no, owners and managers, they are totally different persons. And that's where we say it's a case of joint stock company. So in joint stock company, money comes from the owners, management is undertaken by the manager. Now, since the role is different, do you think there's going to be some sort of fight, conflict, negotiation, some sort of discussion, debate between these two categories? Yes or no? Yes or no? Correct? Definitely. Because their objective is different, right? Owners are the persons who are going to undertake the risk. Managers are not persons who are going to undertake the risk. They're just going to earn salary. The managers are just going to earn the salary. They're not going to earn any amount of, they're not going to face any amount of risk. Am I right, guys? They're not going to face any amount of risk. They're just going to, looking for salaries. Now, suppose if we have a project where an investment of 1,000 crores, where the investment is to be made worth 1,000 crores. Now, as a manager, if it promises you substantial profits, you may be motivated to, put money into that project, because you will say that I'm not going to lose anything because I'm anyways going to have my salary, right? Risk is anyways borne by someone else. So if risk is borne by someone else, you'll be ready to take that risk. Am I right, guys? If risk is going to be borne by someone else, if someone else is going to pay the price for that risk, you will be ready to work. You will be ready to undertake that risk. Am I right? Yes. So when we look at the manager's point of view, their idea is like, we are going to earn the fixed salary income. That's not going to get affected anyways. But then the fixed salary income that we are going to earn is not subject to any amount of risk that the business undertakes. But when we have a proposal in front of us where there is a heavy amount of risk, can they really outpace the thought process of owners and simply undertake the business and simply undertake that project? Yes. Because they'll say risk doesn't matter for us. But whereas risk is a significant matter for owners. So owners will be reluctant to put money into a risky project. Whereas managers would be like, I'm not going to lose anything. My salary is fixed. I'm not going to lose anything. My salary is fixed. I just need to put the money into that business and I'll get my salary as usual. So there will be this sort of conflict coming in. Right? So there is a conflict where managers are trying to maximize their salary and owners want to maximize their wealth. And that's where the problem arises. And this is something what we call it as agency problem. Because understand, managers are acting as an agent of owners. Managers of the joint stock company are actually acting as what? Managers are acting as what? Owners of the, agents of the joint stock, agents of owners of the company. Because they are the persons who are going to act on behalf of owners. Sir, owners cannot take the day-to-day decisions, but managers can. So they are acting like an agent of the owners. So agent should actually be working in what way? In what sense? Agents should actually be working in a sense to maximize the shareholders' wealth. But when you're looking for maximization of shareholders' wealth, you also need to take account of the risk. If you put money into risky projects just because you want to, show that you're putting money, you're undertaking projects, that may lead to reduction in the value of the business also. So how do we overcome this? How do we overcome this sort of conflict of interest between both of them? Right? Ways to resolve this is, whatever is salary, you can just say that, okay, salary would be 50,000 plus 2% of the profits. So when you assign that value, that it's going to be 50,000 plus 2% of the profits, if it's going to be like 50,000 plus 2% of the profits, then how do we go about looking at the business model? I mean, how do we go about understanding their idea? Link it to the profits, link it to the share price. Right? So they are like, okay, so now the managers will think, see, my profit is linked to the, my salary is linked to the profit. my salary is linked to the share price. So if I take a wrong decision, if I take a decision of investing in a very high risky project, can I say the manager may lose some portion of his salary? The manager may lose some portion of his salary. Now, will the manager think about risk and then take the decision of the investment? If I'm linking the salary to the profits, future profits, and also to the cash flows that the company will have, and ultimately maybe to the share prices that the company may have. So now the manager, we're trying to give that cost, or we're going to bear that cost of sharing the profit with the manager just to bring them in line, just to align their thought process in our way. Right? So we are just trying to align our thought process along with the managers. So managers' thought process is aligned with the owners so that they can actually take a call about which project to undertake or not, depending on the risk as it is written. You just can't be looking at the return and overlook the risk and then simply make an investment. So that's something which is problematic. Am I right, guys? So we need to resolve this conflict. So to resolve this conflict, what are we supposed to do? We link the profits, we link the share salary to the share prices, we link the salary to the profits that has been generated by the company, right? And may not be just 1 year profit. We would be like, we can offer a compensation scheme like this. If the company profits increase consistently over a period of time, those employees who are with the organization will get double annual rise. So if the company is performing consistently, those employees who are still there with the company, they will be, given an additional bonus or additional increment in their salary. So this sort of compensation policies need to be decided so that you can have this agency problem and agency cost sorted out. Are we clear, guys? Yeah, sir, does this approach of linking profits and salaries always work? Most of the time it does work, and almost I can say almost it does work, because otherwise, managers would be, will be running at their own pace. They'll be thinking in their own language about whether we should invest or not, by just being a thought process that our salary is anyways fixed, right? Okay, correct. Okay, fine, great, guys. So yeah, so with this, the first part, scope, objectives of finance, is what we have already covered. Now the next aspect is obviously to look into the sources of finance. So we'll be covering this entire slide with you, but before that, I'll be sharing this file with you, by the way, guys. So you need not worry about it. I'll be sharing the file. No need to worry. We'll be able to cover a major chunk of it in our class. But before we go ahead to that part, let's just take a shorter break right now. Yeah, any queries if you have, you can just ask right now before we go for the break. Any queries in the part that we have discussed till now? No queries? Okay, fine. Then let's take a break, guys. So we'll resume around in around 10-15 minutes. Theory topic. So let's take a break, and then post break we'll just take the sources of funds further. Okay, so let's take a break, guys. Shall we continue? Yeah. Okay, so welcome back, guys, after the break. So now we're looking at the next aspect of finance, which is about the sources of finance. So we're essentially looking at what are different ways through which the funds can be generated, funds can be obtained by a business entity. So I've created this chart for you, which I'll be definitely sharing with you. Now, broadly, when we look at the sources of funds, we can classify that into two aspects. One is owned funds. Either you will get the owned funds for your business, or you will get the borrowed funds. Okay. Now, within owned funds, we can further classify that as domestic sources of owned funds and international sources of owned funds. Okay. Domestic and international. Now, under domestic owned funds, under domestic category of owned funds, we can say there is external and internal. Okay. 1 second, guys. Yeah. So external sources and internal sources. So owned funds, domestic, external sources. First category that we have is equity share capital. We know what is equity share capital, right? Equity share capital is a source of permanent capital because generally we don't do the redemption of equity shares. Okay, we can undertake buyback, but that's only if the company has got a sufficient amount of cash flows or sufficient amount of cash reserves available. So it's a sort of permanent capital. Second thing, equity share capital is going to represent the ownership. So whoever is owning the equity shares, he or she is the owner of that company. Then we have this residual interest in income and assets. So this equity share capital is going to provide you residual interest in income and assets. What do we understand by this term residual interest, guys? You might have heard this generally. Equity shareholders are the residual interest or residual recipient of assets. Okay, leftover profits are given to the equity shareholders. Is it only the profits? Is it only the leftover profits given to the company, given to the shareholders? When the company goes for liquidation, right? When the company goes for liquidation, even at that time, whatever is the amount of asset that is left, I mean, the money that is realized by selling those assets, the last distribution will be to the equity shareholders. In fact, payment of dividend is also made to the equity shareholders at the end, right? Equity share capital has got the highest cost of capital, guys. Remember. Now, why would the equity shareholders will be asking for or will require a high cost of capital? Because equity shareholders are the owners of the business. They are the risk takers of the business. So they are having very high degree of risk in the investment. And therefore, they will be definitely asking for a higher rate of return. Like if I ask you, you invest in a bank FD and invest in shares of a company, where would you ask for higher rate of return? Where would you ask for a higher rate of return? Yeah. Of course, you'll be asking for higher rate of return in case of shares. So as a shareholder, you're taking more risk and therefore you need higher rate of return, right? So equity share capital has got a highest cost of capital, and also it provides security to other fund providers. So equity share capital is going to provide security to other fund providers. Now, what do you mean by other fund providers? Let me just tell you something. other fund provider, how does it provide security to other fund providers? So let's say we have got a balance sheet, or rather, let me say there are two companies, A and B. A has got an equity share capital of 10 lakh. Okay. Reserves of, let's say, 1 lakh. Then we have current liability of 4 lakh. And we've got the assets of 15 lakh. Then we have another company which has got equity share capital of 5 lakh, reserves of 1 lakh, loan of 4 lakhs, current liability of 4 lakhs. And of course, assets were 15 lakh. So out of these two companies, if A and B approach to a bank for a loan of, let's say, 5 lakhs. Yeah. If A and B approach to a loan is of 5 lakh money. Yeah. So if both of these companies approach to bank for getting a loan to the tune of 5 lakhs, where will the banker feel safe to give the money? Company A or company B? Why not company B? Why not B can get a loan of additional 5 lakh? Because already B has raised some amount of money, right? Whereas A is debt free. So higher amount of equity share capital, can I say it gives more confidence to the other providers of the fund, right? Right. So that's the point what we are talking of, that it's a security to other fund providers. Now, when we say security, it means a sort of comfort or sort of satisfaction or sort of confidence to the investor, confidence to the fund providers. Okay. Now, some of the advantages and disadvantages that we took it is, first up, equity share capital is permanent. So there is no need for you to repay the capital. Gautam is asking one residual interest. Residual interest is like the profit is given to the shareholder only after interest, preference dividend, tax, and everything is paid out. So one is that thing. Other is when the company goes into liquidation, the last person to get the share in the profits or share in the assets of the company is the equity shareholders. And therefore, they say they are the residual interest earners. Okay. Now, permanent advantages, we say it's a permanent and irredeemable capital. And advantages like, if you are having more amount of equity share capital, it will increase your finance base and it will help facilitate for additional borrowings. There's no obligation to pay any dividend. The advantage is that you also get a power to exercise rights, so you can get the rights issue. Now, what are the disadvantages of debt? The disadvantage, we say dividend is taxable in the hands of the shareholder, because as a shareholder, when you receive dividend, you will be required to pay tax on that. Risky investment. So when you're putting money into the equity share capital, you're essentially putting into a risky investment area. If you issue more of equity shares, your earnings per share will reduce, and also dilution of ownership and control will happen. Now, what are these things? Let me just help you with the numbers. So let's say we have a company which has got a profit after tax, of 10 lakh. Okay. Number of equity shares are, let's say, 4 lakh. Okay. So what is earnings per share? What will be earnings per share? I mean, profit per share. What's the amount of profit per share? If company has got a income of 10 lakh and number of shares is 4 lakh, what is the earnings per share? Can I say 2.5? 2.5 is the earnings per share, right? Now, suppose this number of equity shares, company issues additional equity shares, and now the equity shares have increased to 5 lakh. company issues, let's say, additional shares, and the number of equity shares is increased to 5 lakh. PAT is, let's say, 10 lakh. Then what will be the EPS number? Can I say 2? So if you issue additional equity shares, they're going to issue additional equity shares. So this 2.5 will become 2. Can I say there's a reduction in EPS? Right? There's a reduction in EPS. So that's what we say when you're going to issue equity shares, the EPS is going to get reduced. Moreover, there will be dilution of ownership and control. Now, what is dilution of ownership and control? Let us say, out of this 4 lakh, promoters were holding 3 lakh shares and others were holding 1 lakh shares. So what was the promoter's percentage stake? How much percentage of company were the promoters holding? Because out of 4 lakh shares, we say that 3 lakh shares are held by promoter and 1 lakh is held by others. So what is the promoter's percentage stake? Can it be 75%? Correct. Now, after the issue, what about this 5 lakh? How much is promoter holding? Still 3 lakhs, but others are holding 2 lakhs. So what is the promoter's percentage now? After additional of issue of 1 lakh, how much is the percentage of holding by promoters? 60%. So promoters which were earlier holding 75%, can I say now they're holding just 60% of the company? So if you issue additional equity shares, there is going to be a dilution of ownership. And of course, control also, because as the ownership reduces, the control also reduces. Are we good? Equity share capital raise? Yep. Pretty simple. Now, coming to the other source of owned funds, which is preference shares. Now, preference shares are generally said to be hybrid form of financing. Now, what do you mean by hybrid form of financing? What do you call as hybrid form of financing? It's a form of equity as well as debt. Like debt, you're required to pay them a fixed amount of dividend. And like equity, they are owners of the company also. The rate of dividend is generally going to be higher than the rate of interest. These can be cumulative, non-cumulative, redeemable, participating, non-participating, convertible also. Now, we are aware about what's the cumulative preference share and non-cumulative preference share, right? We're aware of it, right? Yeah. Cumulative and non-cumulative. Cumulative is basically your interest preference dividend will keep on accumulating over a period of years. Whereas in case of non-cumulative, there is no such accumulation happening. Then we have redeemable, which is the redeemable will be like redeemed after a period of time. Achha, participating and non-participating. Participating means those preference shares which will be given a share in additional profits or extra profits that company might have made. So they can participate in the extra profit that the company has made. For example, company may say that these are participating preference shares if the profit of company is above 100 crores. If the company is having a value, or if the company is having a investment, having a profit of more than 100 crores, so above 100 crore, whatever comes, a portion of that will be given to the preference shares. So if you have such condition, then it's called as a participating preference share. If there's no such condition, then it's a non-participating preference share. Okay. So participating shares is basically giving a share in the excess profits. Giving a share in the excess profit. Okay. Then advantages and disadvantages. There's no dilution of EPS because when you issue preference shares, your EPS is not going to get reduced. Advantage of leverage, you will obviously get the advantage of the leverage. There's no risk of takeover. So if you issue preference shares, if someone buys those preference shares also, that person is not going to get the voting power. And therefore, there is no risk of takeover. Dividends are fixed and pre-decided, redeemable after fixed period. And the disadvantage is that whatever preference dividend you pay, that is not tax deductible, like interest. Interest is an expenditure, but dividend is not counted as an expenditure from the tax point of view. And then you have cumulative preference shares. That's a disadvantage, that in spite of being preference, in spite of being share capital, you are required to pay the amount of unpaid dividend in the future years. Okay. Is the participating shareholder get the profit before or after equity shares? After equity shares, Guram. What is the rate of dividend is higher than the rate of interest? Since preference shares are having a higher risk than the debenture holders, the rate of interest that will be given to them will be higher than the rate of dividend, will be more than the rate of interest. Like if the company borrows money, now company will have to pay, let's say, 10% rate of interest. But for preference shares, you may give them like 11 or 12% dividend. Okay. Equity shareholders have an unlimited profit. I said that if it is participating, only if the profits increase some basic level. So if it crosses that threshold limit, then only a portion of that profit will be given to the preference shareholders. Like if the profit increases above 100 crores, whatever profit is above 100 crores, out of that, maybe 5% or 10% will be given to the preference shareholders, in addition to the regular dividend. Okay. Yukta, it's not disadvantage for the company, it's a disadvantage for the shareholder. Okay. Now, internal sources, preference dividend not tax deductible. Interest is not tax deductible. Interest is allowed as a tax expenditure. When you pay preference dividend, it is treated as a distribution of capital or drawings, and therefore it's not allowed as a deduction. It's not treated as an expenditure in tax language. Okay. Then coming to this ADR and GDR concept, guys. Man. Let's look at this simple concept. See, global depository receipt or American depository receipt. So, for example, in India, we have Infosys. If Infosys wants to list its shares in US market directly, so Infosys directors just take the shares, they take 10,000 shares in the market, they stand on Wall Street and then they shout that shares of Infosys are available at so and so price. Those who are interested can buy it. Are the US investors going to buy the shares of this company, which is an Indian company? No, they will not buy it, because these shares have no recognition in US. Same way, even US companies have no recognition in India unless and until they establish their business over here with the Indian type, Indian registration. So if Infosys wants to get its shares listed in US market, that's not possible directly. So what Infosys is going to do is, it's going to take its shares and give it to a depository in USA. Now, who's a depository in USA? Who is a depository in USA? Who is a depository? Depository is basically bank of shares. Just like bank keeps our currency, just like the bank keeps our currency, US is going to keep the depository. Depositories are the persons who are going to keep the shares and all dematerialized form. And generally, you open the demat account, right? You open a demat account with a broker, but the broker actually is a member of a depository, right? So that depository is going to hold that shares on behalf of the investor, just like banks hold cash on our behalf, right? Same way you have depository. In India, how many depositories do we have? Which are the depositories in India? Two. What are they? CDSL and NSDL. Right? CDSL and NSDL. These are the two depositories in India who hold the shares on behalf of the investors. Same way, you will have a depository in US. So what Infosys will do is, it will give 10,000 shares to the US depository. It will give 10,000 shares to the US depository. The US depository in turn will issue receipts in the market that we have received 10,000 shares from an Indian company, and each of our depository is worth 100 shares of that company. So for 10,000 shares, we are issuing 100 depository receipts in the market. Now, is this depository receipt going to be accepted by the investors in US? Yes, that's going to be definitely accepted, because now it has been backed, or it has been issued by a US authority, right? So US authority has issued it. Definitely, it will have a legal backing, and then the money comes to the depository in terms of dollars. Depository transfers the dollars to RBI, and then RBI finally gets it in the form of rupee. Okay, so RBI gets it in the form of, RBI transfers the money to the Infosys in the form of rupee. Of course, there are charges that are applicable over here, which goes from Infosys to US market, and then from US market to Infosys, the money comes in. So that is definitely going to be there. Okay. Yeah, Christian, you can unmute. Out, Christine. Two doubts. That 100 year is 100 depository receipts. 100 depository receipts.
Hello, sir.
Yeah, Nikhil.
Sir, can we say depository as a custodian of share?
Depository as a custodian of shares. No, custodian is a separate person. Custodian is a person who is keeping shares on behalf of a mutual fund. Okay, custodian is a holder of equity shares on behalf of the mutual fund. We don't use the word custodian. Depository is holding shares on everyone's behalf.
Okay, sir. Thank you so much, sir.
Okay. Okay, so depository receipts procedure is clear. You give the shares to a depository in US. That depository participant will accept the shares of an Indian company, and it will give its own document in the US market. Right? It will give you its own document in the US market, against which dollar will be collected by the depository, and that money will be transferred to RBI. Okay. Now, if you're going to US market, we call it as American depository receipt. Same way you go to Japanese market, that will be Japanese depository receipt. If it goes to England, it will be UK depository receipt. If you go to France, it's France depository receipt. So depending on which market you are raising money, the depository receipt will be named accordingly. Okay. Now, that's the international sources of GDR or ADR. Now, coming to the borrowed funds category. In borrowed funds, we have a lot of instruments. We'll be covering maximum to whatever possible extent. So first, looking at the domestic area. So in domestic form, I have classified this borrowed funds into long-term, short-term, medium-term, or long, short, or medium-term. So when we have domestic sources of borrowed funds for a long-term domestic sources, when we talk of, the first thing that we have is something called as seed capital. Okay, seed capital. What's the meaning of the seed capital? Seed capital is generally provided to the startups, right? So seed capital is provided to the startups. Now, generally, startup companies, do you think they will have sufficient cash flows and profit to pay interest? Startup companies, are they going to have sufficient cash flows and profits to pay interest? No. Then how do we support them? So this IDBI, Industrial Development Bank of India, it provides them interest-free loans for them. But then they say that we will charge you just 1% for the first 5 years. So for the initial 5 years, they're going to charge you just 1%. And then they will say, like, depending on how the business makes money in future, they will charge a higher rate of interest, right? So repayment and rate of interest charge depends on repaying capacity with a moratorium of up to 5 years. So up to initial 5 years, they won't charge you any interest. After that, they will start charging you interest at a higher rate. Okay. That is a seed capital which is provided where the interest is not paid, but a service charge of 1% is charged. And as and when the business matures, when the business is having sufficient cash flows, there you take help of the company cash flows to pay the capital. Second instrument is called as a zero coupon bond. Have you ever heard of this term called as zero coupon bonds? Yes, correct. Mohit, you are right. Moratorium is concession and repayment schedule. What is this zero coupon bond? These are not government securities. These are not government securities. Generally, what do you understand by the bond? What do you understand by the term bond or debenture? It's a loan, right? Now, suppose if a bond is issued, if I buy a bond, or let's say a company raises a bond, we are talking of company point of view, year and cash flow. Year zero mein, company will receive, let's say, 1,000 rupees from issuing the bond. Year 1, 2, 3, 4. Every year, company pays, let's say, 120. Every year, the company is paying, let's say, 120 rupee interest. Right? And then in the fourth year, finally 1120 is paid. So 1,000 is a cash inflow. 120 is paid every year till fourth year, and then finally you have 1120. Finally you have 1120. So now this is a typical coupon bond. So this 120 which you are receiving, these are called as coupons. These are called as coupons. So you invest 1,000, you receive 120 every year, which is 12%, and then finally you also receive the principal amount. That's a normal bond that we are talking. But when we talk of zero coupon bond, it means there is no coupon. So in such bonds, company will receive, let's say, 60 rupees now, and directly at the end of fourth year, it will pay back 100. So it's like you took a loan of 60 and repaid 100 along with interest. So you got 60 and then you repaid 100 along with interest. So what's the interest that you're earning? What's the amount of interest that you are paying in this period of 4 years? 40, right? That 40 is the interest. Does that mean there is no interest? No, there is interest. But in between, like a normal bond, you don't pay 120, 120, 120 every time. You just pay like you got 60 now. You repay it with interest, cumulative value, total amount at the end. That is 100 rupees. Got it? That's your zero coupon bond. So they are no interest bond issued at discount and redeemed at par. Like we are issuing at a discount, in our case, like at 60, and then we're redeeming it at 100. There are something called as deep discount bonds also. Now, what are these deep discount bonds? What are the deep discount bonds? Deep discount bonds is like, we are issuing the bond at a price of 10 rupees with a promise to redeem it. We are issuing the bonds at a price of 10 rupees with a promise to redeem it at a future value of 100. But the redemption will happen 30 years from now. So it's like you pay 10 now and you'll receive back 100 after 30 years. You pay now 100 and you will receive 100. So you will pay now 10 and you will receive 100 at the end of 30 years. Can you see there is a heavy amount of discount over here? Like look at the difference, 10 to 100. 90 is the discount. So that is where we say it's a deep discount bond. Got it? So it's a zero coupon bond, but whenever you have a heavy amount of discount into the longer tenure, those are called as deep discount bonds. Okay. Yeah. What is the benefit for investor, sir? Benefit for investor is earning interest out of it. Interest benefit, investor is earning 90 rupees interest, right? For a longer tenure. Yes, you can unmute. Audible, Mazi. Okay. Anyways, now coming to the next part, which is secured premium notes. Now, what are these secured premium notes? Secured premium notes are redeemable notes issued along with detachable warrants. Okay, detachable warrants. Warrants need to be converted within time specified by the company. Uh, what are these detachable warrants? Now, see, you have a debenture, and there's a warrant over here. Now, this warrant can be detached. It means you can just tear it off. And if you present this warrant, you will get shares for ₹5. Okay, so this warrant gives you power to buy the shares at a price of ₹5 per share. So warrant is like it's giving you option to buy the shares at a very discounted value. That is upon you whether you want to use that warrant or not. If you want to use that warrant, you will just tear it off, give it to the company. Company will give you a share for a price of ₹5. Whatever, let the price of share be whatever, be it 50, 100,000, whatever it is, you'll still able to get the bond at a price of share at a price of ₹5 because that is stated in the warrant. Okay, so that's a secured premium note or a redeemable notes along with detachable warrants. You can remove that warrant, present it to the company, maybe within a period of 4 to 7 years, against which they will give you the shares. Okay. Now, in case of bonds, you may have bonds which are, something called as callable bond and puttable bonds. Again, there is some. Yeah. There is something called as callable bond and puttable bond. What is this callable bond and puttable bond? Callable bond, there is a power with there's a power with company to the bond before due date. So in case of callable bond, the company has a power. In case of callable bond, the company is having a power to redeem the bond before due date. So it's like if the bond is going to be redeemed on 10th year or in the 10th year, then due to this callable feature, the company can redeem this bond before that also. Okay. So we can get the bond. Company can redeem this bond before the due date also, before 10th year. Right? It will not wait for 10th year. It will have a power to redeem the bond anytime before 10th year. So when that feature is there, we call it as a callable bond. And when it is a puttable bond, then we say that there is a power with investor to sell the bond to company. Power with investor to sell the bond to the company before maturity also. So it's like you can get the bond redeem before the due date. So when the power is with the company, you call it as a callable. When the power is with the investor, you call it as a puttable bond. Okay. Then we know what is a typical debenture is. What a debenture is. Okay, there's some error in the screen sharing. Yeah, I did that. Okay, so what is the advantage of company redeem before due date? Company can save on interest, right? What is the advantage of company can save on interest? The company can actually save the interest. So if it's like if the company is having a sufficient cash flow, then it can simply save on the interest. What for the value of debenture we get for value of debenture we get shares at 5 per share. No, debenture will be there. Debentures are still going to be there, but 5 rupee share will be separately issued to you by paying, of course, 5 rupees. Market price of share may be anything. Okay. Then there's this concept called as floating rate bonds. Floating rate bonds. So what are these floating rate bonds? Listen. Usually, what we observe is from the company's point of view, a normal bond. Yeah, floating rate bond. How would a normal bond function from a normal point of view? It's like in year 0, 1,000 will be the cash flow that a normal investor is going to put. And then from year 1 to 5, every year you are going to receive 90 rupees along with the redemption value of 1,000 on maturity. But in case of floating rate bond, the interest rate is not fixed like every year 90, 90, 90. Right? So every year 90, 90, it's not that case. The floating rate bond from year 1 to 4. So from year 1 to 4, the amount of interest will depend on what is the RBI repo rate. So rate of interest that is specified in the rate of interest, rate of interest is specified in the floating bond. That's RBI repo plus 3. So as the repo changes, RBI repo rate changes, the rate of interest or the coupon also changes. So if let's say RBI repo is 5%, so you will get a coupon of 5% plus 3%, which is 8%. That translates to 80 rupees. Same way, if RBI repo turns out to be 6%, then you'll get 6% plus 3%, which is 9%. So as the RBI repo changes, the cash flows also changes, and that happens because of the floating nature. So in case of floating rate bond, your cash flows are not constant. Whereas in normal bond, your cash flows are going to be constant over. Okay, so that's your floating rate bond. Then we might have heard these things: overdraft and cash credit. Can you tell me what will be the difference between overdraft and a cash credit? What would be the difference between overdraft and cash credit? I hope we have heard of both these terms. Yeah. Overdraft and cash credit, are they same or are they different thing? Are they same or are they different things? Different type of arrangements. Yeah. Cash credit is given on receivables. Well, overdraft can be a secured loan or unsecured loan. Cash credit has to be secured by way of working capital hypothecation. So overdraft are generally allowed to withdraw in excess of the credit balance in the same current account up to a fixed limit. They are repayable on demand, but generally continue for longer periods. So overdraft is like whenever the bank wants, it can demand back the money from you. Whereas cash credit, it's an arrangement under which a customer is allowed an advance up to a certain limit. So the customer will be allowed to withdraw amount certain limit up to loan or withdraw money up to a certain limit. If the customer, if whatever amount you're withdrawing, you'll be charged interest only on that. That's the same case with OD also. So interest is charged only on the amount withdrawn. Generally, cash credits are sanctioned against pledge or hypothecation of the trade receivable goods. Okay. Intercorporate deposits are the deposits or short-term borrowings that the corporates make with each other. One company investing in another company. That's an intercorporate deposit. Okay. Then we may have commercial papers also issued. Commercial papers are like short-term debentures which are issued by uh, high-rated corporates. So corporates who are having a good amount of profitability, a good amount of credit rating, their balance sheet is very strong. So when they are very reputed corporates, they are allowed to issue commercial paper in the form of a promissory note, uh, and they are issued by high-rated corporates, primary dealers, and audited financial institution. Minimum amount of investment is 5 lakh or multiples of that, and generally rate of interest is linked to the 1 year government bond. Okay, so there's a rate of interest which we have in 1 year government bond. Whatever is the government bond, based on that, some additional amount will be there for denomination, right? Now, this is obviously mandatory to obtain the credit rating, commercial papers. So the commercial papers are mandatory to have to obtain a credit rating. Because they are high rated corporates, obviously there will be a more regulation following them, and they'll be allowed to obtain a credit rating from the credit rating companies. Then we have something special bond type of bonds that we talk of. So there is Yankee bond, samurai bond, and bulldog bond. Now, what are Yankee bonds? Yankee bonds are dollar denominated bonds which are issued in USA, but not by a US company, but these are issued by a non-US banks and corporations. So those banks and corporations which are not listed in US are allowed to issue these bonds in US. So like as an Indian company may go to the US market, and like an Indian company, we may go to the US market and ask for money from the investors, but then I'll be issuing key bonds over there. I cannot issue Indian bond because in US they won't recognize the Indian bond anyways. Same way, if you go to Japan and issue Japanese bond, but being a non-Japanese company, then you call it as a samurai bond. Same way, bulldog bonds are issued in UK by a non-UK company. Now, suppose if I ask you, which country would are we talking of when we're talking of maple bonds? Maple bonds. Which country are we really talking of? Like Yankee bonds are denoted by the bonds issued in USA, samurai in Japan, and bulldog in UK. Same way, maple bonds. Where do you think? Where are they issued? Of course, they are issued in Canada. Correct. Yeah. So yeah, maple bonds. So even we may have some sort of these bonds, and there's one more bond that we're talking of is masala bonds. So bonds which are issued outside India but denominated in Indian rupee. So bonds which are denominated in rupee terms, like Indian companies issuing Indian bonds outside Indian market, is what we call as a masala bonds. Okay, so it's a typical name that we assign to the bonds depending on the location. Okay, so apart from that, you have international agencies, medium-term notes, Euro commercial papers. I'll just share this on the portal. You can just have a look at this. Okay, and then we can obviously discuss about if you have any queries in that. But yes, one thing I would like to discuss is about the lease financing. Now, lease is basically taking the asset on lease. You can take the asset on lease or either on finance lease basis or on operating lease basis. So in finance lease, generally the tenure of the lease is longer, and operating lease, the tenure of the lease is smaller. In finance lease, risk and reward is transferred to the lessee. The lessee means the person who is going to take the asset on lease. Risk of obsolescence, again borne by lessee. They are non-cancelable. Repairs, maintenance, everything is undertaken by lessee. Full payout, almost whatever amount you receive under finance lease, that's almost equal to the value of the asset. Whereas in operating lease, it's like not a longer term, it's a cancelable, right? So longer term lease can be classified as finance lease, and short term lease can be classified as operating lease. Okay, what is denominated in Indian currency or Indian rupees? What is denominated in Indian rupee? Okay, denominated in Indian rupee. In what is it? Denominated in Indian rupee means the value is stated in terms of Indian rupee, not in terms of dollars. Like if Indian rupee is being traded in US market in rupee terms only, then you say it's a rupee denominated bond. Okay, now I'll just allow you to ask me queries. You can raise your hands. I'll answer queries then accordingly. The last 10 minutes, I'm just reserving for the queries that you may have. Yes, Anubhav.
Good evening, sir.
Good evening, Anubhav.
Sir, could you please explain the deep discount bond once again?
Deep discount bond, zero. I hope you understand what is zero coupon bond.
Yes, sir, I got it.
Yeah. So when the discount is very large, like if you are issuing a bond for 10 rupees with a face value of 100, so it's like there's a discount of 90 rupees. Right? So that 90 is the interest that you're earning over a period of 30 years. So when there is a heavy discount, in case of zero coupon bond, those zero coupon bonds are said to be deep discount bonds.
Okay, sir. Thank you.
Yes, Prabhakar. Prabhakar. Yeah.
Good evening, sir.
Good evening, Bhumika.
Can you please explain once again callable bonds and puttable bonds?
Callable bonds. Normal bonds, if it is bond, if the bond is for let's say 10 years, so your bond is going to be redeemed after 10 years, correct? So if the bond is
Yes,
having a
sir.
maturity of 10 years, it will be redeemed after 10 years. But if there is a clause in the bond that the company can redeem it before due date, right? Instead of redeeming it in 10 years, the company has the power to redeem it in 6th year itself. Then it becomes a callable bond. Same way, if as an investor, I have the choice, I have the option to give the bond back to the company and get it redeemed before the due date, then it's called as a puttable bond.
Okay, sir. Thank you.
Okay. Yes, Yukta.
Good evening, sir.
Good evening, Yukta.
Sir, in this module, there is a concept called yield curve note. What is that?
There's a concept called as yield
Curve note.
Here it is. It's an inverse floater. Generally, what you observe is that as the rate of interest rise in market, the interest rate on the bonds that are issuing in the market also rises, right? So if the rate of interest is rising in the market due to RBI action, the rate of interest for the bonds also rise. But these yield curve note are a separate bond or a different one where the yield increases when the prevailing interest rate decline. So it's like an inverse thing. If you say market in the market the rate of interest is rising, one who is holding this yield curve note will be having a lower rate of interest. It's the inverse position that happens in yield curve note. Okay, so the yield curve note is as a market rate of interest rise, the rate of interest on these bonds fall. Okay. Yes, Manisha.
Yes, sir. What is the meaning of FRN?
What's the meaning of?
FRN. It is under
FRA?
the head of International Borrowed Funds.
Floating rate note. These are floating
Yes,
rate
sir.
note. Right? So adjustable interest rate. So as the interest rate as the exchange rate changes, the interest rate also changes.
Okay, sir.
Guram.
Sir,
Hmm.
you have told me about the deep discount bonds.
Uh,
If they want to sell it for 100 rupees, if they want to take the shares at the 100 rupees after 30 years, if the shares of the company is
there is no
more than
share.
that,
There is no concept of shares in deep discount bond.
okay,
Deep discount bond is redeemed for cash only. Where is the share involved here? It's a debenture.
okay,
Okay, there's no share.
okay, sir.
Prabhakar. Yes, brother. Are you trying to say something? Yes, brother. Yeah. What's the query? Form of IDBI. IDBI is Industrial Development Bank of India. Form of IDBI. IDBI is Industrial Development of IDBI. IDBI is Industrial Development of IDBI. Drop lock bonds. Drop lock bonds is like again floating rate bond, which will become a fixed rate bond if interest rate goes below certain rate. So if interest rate falls below certain rate, this floating rate bond will become a fixed rate bond. Okay. Manisha?
Sir, there are more topics to be covered in the chart that you have given. So, will you
Yeah.
explain those in the next class, or we can read them
I'll
and
just
we
share
will...
it with you. You just read through it. And whatever topics you're not able to get it, we'll discuss that in the next class.
Okay, sir.
Okay. Fine. So, yeah, there's no set of queries now. Yeah, then let's just call it a day. Yeah, done. See you tomorrow, guys. Bye-bye.